Every trader knows what it's like for a trade to go against you. That's just part of the reality of trading. But what if there was a way to make mid-trade adjustments that turn trades that might be headed for a loss into winners? I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan. And the traders on our proprietary trading desk are trained to make adjustments to their options trades so they avoid getting stopped out on trades and in many cases turn them into winners. If you'd like to learn how professional traders turn losing trades into eventual winners, then stick around because I think you're going to find this pretty eye-opening. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so we're moving into the summer months, and some of the market technicians out there are beginning to talk about the notion that this is going to be a summer where the market just chops around in a range, not moving particularly strongly in either direction, either up or down, until there's some clarity around whether the Fed's attempts to fight inflation will be successful or whether more drastic measures will be needed to tame inflation, which most likely would result in driving the economy into a recession. And in fact, several weeks back, we might have been seeing the early signs of this chop when on May 9th, the SPX index, the index representing the S&P 500, opened up at 4081 and then sold off later, retesting that same area around 4090 a few days later, and then sold off again, finding support in that 3810 area and then bouncing a bit by May 25th. And so options traders might look at those prior few weeks on the SPX and put forth a thesis that the SPX will continue to chop around inside that 3810 to 4090 channel for at least another week. Now, before we get into how we'd construct an options trade around that thesis, I wanted to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. In order to explain how this strategy works, we need to make sure that everyone watching this video understands how index options work. So we're going to do a really quick review of them and then just jump right back into the details of the strategy. All right, so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts are just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. Okay, so with that in mind, remember that we've established our thesis that we'll be getting another week of chop in that 38.10 to 40.90 area. And so on the morning of May 26th, let's suppose that we pulled up the options chain that expires a week later on June 1st. And we went up to the 41.30 call strike, well above what we saw as resistance, and we sold 5 of those and simultaneously buy for protection 5 of the 41.80 calls, 50 points above the 41.30s that we sold. We moved down to the 3,800 puts below what we saw as the support and sold 5 of those, and then moved down further to the 47.50 puts and buy 5 of those for protection. Well, that entire combination of short calls protected by higher up long calls and short puts protected by lower down long puts, that entire structure is what options traders refer to as an iron condor, which would be a strategy you could implement with this thesis for reasons you'll understand as we continue. Now, let's first do a quick analysis of what's happened here from a cash flow standpoint before we move through the trade. And as you can see, we sold the 41.30 calls for $7.30, and each point above 41.30 is worth $100 per point. So we multiply that by 100, and we sold 5 of them. And so multiplying it all out comes to positive cash flow of $36.50 for those 41.30 calls. And as you can see from the same kind of calculation, we spent $1,500 on the 41.80 calls, and using that same logic, we receive $29.75 for selling the 3,800 puts, and turned around and paid out $15.15 for the 37.50 protective puts, resulting in a net positive cash flow of $36.10, for which your broker, by the way, will require $21,390, which is the trader's worst case scenario. Okay, so now let's move to the end of that day. And as you can see, at one point, the SPX in that first day almost hit the top of our range, which remember was 38.10 to 40.90. And so that's not a good thing. And why do I say that? Well, think about it. If we've sold 5 calls and the market moves higher than the calls and stays there, then we're going to have to pay out on each of those 5 calls $100 per point for each of the calls. And that can get very expensive. So what options traders are trained to do in these circumstances is to roll the call options up in price and out in time, also known as an up and out roll. In this case, closing the 41.30 and 41.80 calls expiring on June 1 and rolling them up to the 4,200, 4,250 calls expiring one day later than before on June 2nd. This moves both options up 70 points, giving additional room to the trade should the market crack through that resistance at the top of the trader's theoretical range at 40.90 and then keep running. Okay, so now let's take stock of where we are at this point from a cash flow standpoint so you'll understand what just transpired. And as you can see from the calculation, we start out with the cash we've already received from opening the iron condor, the 36.10, and we deduct from it what we paid to buy back and close the 41.30 calls expiring on June 1st, and add what we received for selling the 41.80 protective calls, as well as the 4,200 calls we sold on the June 2nd expiration chain, and finally deducting out the cost of the 4,250 calls that we buy to protect the June 2nd position. And as you can see, that resulted in our cash flow being netted down to $985. Okay, so at this point, let's move forward to June 1st. And as you can see, the SPX index closed at 41.01 that day. And so remember that the original put side of this trade expired on June 1. And since those puts are located at 3,800 and 37.50, they both expire worthless because they only pay off if the market closes below their strike prices. And the market obviously closed hundreds of points above that. And so from a cash flow standpoint, this expiration means nothing to our trade. The options simply expire and they go to options heaven with no value. Okay, so now let's move forward to the day that the call side expires, which is June 2nd. And as you can see, the SPX index at that point had now broken through the trader's range, ultimately closing at 41.76 on June 2nd. Well, this is the day that the final piece of the trade, the call options, are expiring. And so let's see how this trade wraps up. And so we first take into consideration the netted down remainder of our cash flow, which is $985. And you'll recall that the puts expired 2 days earlier with no value. And on June 2nd, the calls also expire with no value, because with calls, there's no payoff unless the market closes above their strike prices. And the call strikes are way above where the market closed, resulting in those also expiring with no value, which results in our profit being the cash we were left with after the up and out roll, which is 985. And so what I'd like you to take away from today's video is that if your original premise is wrong and the market does not stay within the ranges you had originally thought, options trading offers you the flexibility to make a mid-course correction, to basically widen the trade so that if the market seems to be breaking through an important level, you have the flexibility to move the trade around so as to buy yourself more room and bring the trade in for a win, even though your original premise was wrong. In other words, you can still win on options trades even though you were initially wrong by adjusting up and out and buying yourself some more room in that process. That additional room comes at a cost, of course, as you saw, because you had to spend a chunk of the original cash flow you received initially, but you've just increased your chances of winning big time by buying yourself room and allowing the market to cool off as you close your trade for a win. Just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.